Obviously, the important thing here is the disclosure that is made in the investor's IT12 return. The disclosure of assets and liabilities in South Africa is required in a tax return in certain circumstances, and there's a detailed disclosure for South African-based assets. But as far as foreign assets are concerned, the disclosure is broken into two items: total assets and total foreign liabilities. The investment then into the IBC as a subscription for shares would then be regarded as a foreign asset and be disclosed as such. Obviously, there were no foreign liabilities in the example. And at any point in time, the investor may elect to take a return of his investment held in the foreign company. So the foreign company, being the UAE company, can buy back a portion of the shares initially invested by the South African investor, and that will be a return on capital up to the initial subscription price. There will be no capital gains tax, and anything over and above the initial subscription price will trigger a capital gains tax. Obviously, we want to ensure is that the investor at all times retains a minimum 10% investment in the foreign company in order to ensure the flow of dividends remains exempt from taxation in South Africa. The trust itself is not a South African entity. It will not be required to disclose its assets and liabilities to the South African Revenue Service. And obviously, one of the other items that needs to be disclosed on the tax return is the receipt of annual dividends. It is disclosed as a exempt dividend, but you need to disclose the receipt of it. So SARS is capable of performing a capital reconciliation. And what that basically means is SARS adds up the total income earned by a taxpayer in any tax year, takes off his living expenses and his tax liability, and then determines whether the increase that's in his capital justifies the amount of increase in capital that he actually has disclosed. So therefore, just the closing point there is that the investment is held by a foreign company. The directors which I never mentioned, directors of the foreign company are provided by JurisTax, being a fiduciary service provider. So therefore, the foreign company is considered to be managed and controlled in South Africa. We ensure that the funding of the foreign company is done by way of a subscription for shares as opposed to a loan. And therefore, the provisions of Section 7.8 don't apply, and the provisions of 7C don't apply. The investment returns are made in the tax-free environment. And to the extent that returns are disclosed as investment returns to the trust as opposed to investment returns to the individual, the initial investment made by the investor could well decrease by virtue of the income being distributed to the trust. Nikki, I'm going to hand over back to you.
Great. Thank you very much, Ian. We've had a few questions, and I would just like to go through some of the questions that we've received for Tommy and Shri at PSG. The first question was that it reads, the US markets have been very bullish. Is there still momentum for this run to continue? Tommy and Shri, what are your thoughts on that question?
Yeah, thank you very much. It's a good question. We do get it a lot. I think the consensus answer to that is yes. I think as long as the stimulus is still coming into the system and as long as inflation rate is still keeping low, there's definitely more momentum in that market. But we do have to start highlighting the drawdown risk as well. Obviously, as markets become more expensive, the drawdown risk becomes quite high. And we need to look for other opportunities now we can protect capital forward. And as I said, the next crisis is just around the corner. We don't know what it is yet. but you need to be positioned and well diversified for when that happens.
All right, thank you. And the next question we received through was, how are PSG's portfolio positioned, given this this first question?
If you're comfortable, I'll take that one. I think good question, Nikki. And you guys see the screen. I just want to make it full screen this time. Good question. I think what's important is that America is not the world. So you want to be able to diversify and ensure your portfolio is positioned in other markets and other regions. One of it is emerging markets. So you might see the like of a Taiwan semiconductor in there in a portfolio that gives you emerging market exposure to a tech sector, as an example. I think what's also important is that we've diversified across managers and across investment styles. So one of the slides, and I'll just jump through it, is that each manager has a role in a portfolio and brings a certain unique ability. So sort of BlackRock's a tracker, that's an index, whereas a Fundsmith equity managed by Terry Smith in the UK has a very high conviction to about 20 or 30 shares that he positions that in a place for long-term growth that can see out cycles and allow for that growth. So I think there's a lot of work that goes into how we position our portfolios and how we select our managers and partners, and just to bring that comfort to investors and clients that we are thinking about and we are looking forward in terms of what we've seen in American markets, what we see going forward, also in terms of opportunities for clients.
All right, Shri. And then another question that was posed to your team was, there's a noise in the market about a looming potential crisis, which may be brought about due to financial stimulus packages globally, particularly in the US. Is there something to be concerned about?
Yeah, Nikki, I think that sort of links into the argument that we have about possible inflation pressures. I think it was Mike Tyson that said, you know, everybody's got a plan until I hit them in the face. And then they start, you know, changing their plans. And I think that's one of the things that we try and avoid. We're trying to sort of highlight that risk. Sort of one of the other risks that we see, obviously, the said is equity prices, you know, becoming too expensive and might create some sort of a bubble in certain of those sectors. So it's more of just being aware of the hits that might hit you in the face and how you're going to recover from that. Then try to just go into the ring and just think that each and every blow that you're going to hit is going to be a knockout blow. So it's, yes, there's always rumors of some sort of a crisis or some sort of concerns. As I said, you know, we started off last year with almost a third world war that was going to start, you know, when Donald Trump got one of the, I think it's Iranian generals. You know, we had a very, very unstable start to the year, various different things happening, and even Prince Harry, you know, resigned from the family business. And we thought that was going to be the worst. And the next moment, COVID hit us. And you have to be prepared for that. You sort of have to construct your portfolios that you are strong enough to withstand all those blows that's going to come your way, because it's definitely going to come. And yeah, there's, as I said, there's a lot of players, there's a lot of people that's always predicting the next crash. And, you know, a blind chicken will pick up a mealy every now and again, and it happens, you know. But you have to be prepared. And that's all we're trying to do from our side. You cannot forecast what's going to happen next today. But what we can say is we know what happened in the past. We know how markets recovered in the past. We know what kind of asset classes you need to be in if certain things happen, and that's how we construct the portfolios.
Wonderful. Thank you. Thank you so much, Shri and Tommy. Then one question, Ian, that came through that I'd like to pose to you. One of the participants asked, is there a requirement for a South African resident to report the existence of an offshore trust arrangement to SARS? I know that you have mentioned reportable arrangements in your presentation. Is there anything you'd like to add to that?
Yeah, I did respond to Mohammed. This disclosure to SARS happens by virtue of something called the reportable arrangements and legislation. And it says where a South African tax resident establishes a foreign trust and is believed that the NAV of that trust will exceed 10 million rand, then the existence of that trust must be reported to SARS. In this scenario, the trust has been established by a RAK IBC, so therefore not established by a South African tax resident, and therefore the trust need not be reported. Obviously, what does need to be reported is to the extent that distributions are made by the company to the South African tax resident, you are going to declare the receipt of an exempt dividend, and to the extent to which the trust makes a distribution to the South African tax resident, you are going to then declare the receipt of a partially exempt dividend. But those are the two disclosures that are made. So there won't be specific disclosure as to the name and the jurisdiction of the trusted structure, but merely the fact that you've received income from the trust or company. That answers that question.
Yes, that's great. Thank you so much, Ian. I don't think that there was any other questions that I've seen come through. I see there's one over here. One asks, Ian, what is your view on the use of international retirement plans by South African residents? This perhaps as an alternative to a foreign trust.
Yeah, they certainly have got merit. And there's a lot of uncertainty in the SA tax legislation regarding the receipt of a foreign pension, the use of a foreign pension. Let me start by saying that there is an exemption that sits in section 10(1)(gc) of the SA Income Tax Act. And it says, where services are rendered offshore and you receive a pension in respect of those services, that pension is exempt from taxation in South Africa. In the case of a foreign pension, which equivalent, I'm going to equate it to a foreign retirement annuity fund, i.e. there's no services attached to it. Then the legislation provides, then certainly the investment return made by the foreign pension fund is exempt from tax. The distribution of those returns back to South Africa, provided this isn't structured as an annuity, a periodic payment, then it represents a return of capital. So the amount of money that you put in, that first gets returned free of tax. And then any other distributions of that amount over and above the initial capital will then be considered to be a capital gain and subject to tax at the appropriate tax rate in South Africa. So there's certainly an element in the investment portfolio for a foreign pension fund. And depending on your circumstances, it may be very, very beneficial or merely has the objective of ensuring accumulating your funds tax-free, and then the ultimate return of those funds will be subject to capital gains. There's also different opinions as to whether the asset is subject to estate duty or not, but I'm not going to venture down there.
Fabulous. All right, everyone, I'd like to thank you for joining us today and thank our panelists, both from PSG, which is Tommy and Shri. Thank you very much, guys. I found it incredibly interesting what you do, how you position the clients' portfolios. Learned a lot today. Ian, thank you so much. Was a great refresher on taxation, even for me. And yes, we've recorded the webinar. We will be sending out our recording to those who wasn't able to join today, and those that were able to join, you will receive that with our presentations as well. Thank you very much, everyone. Have a lovely weekend.